Welcome to Thursday Dairy Update. This is Kathy Barrett with the Cornell PRODAIRY program. PRODAIRY, along with Dairy Business Communications, is pleased to be able to offer this webinar series. Today's webinar topic is Valuing Farmland Proximity. We're pleased to be able to have Dr. Jennifer Ifft, Assistant Professor at the Dyson School of Applied Economics and Management at Cornell University. She will be talking about methods for valuing proximity in farmland purchasing decisions.
Like Cassie said, I'm going to be talking about valuing farmland proximity today. And my objective here is to demonstrate some of the benefits of farmland proximity and talk about how we can go about thinking about what those benefits are and how they can be estimated. A few years ago back, I was at a conference at the USDA headquarters on farm succession, and somebody who'd been working in this area for decades was joking. He said, well, you know the answer to the question, when do you buy the farm? The answer is when it goes for sale. Now, I think this is the reality for a lot of farms, that just because of how farmland markets are, and I'm going to be talking about that in more detail, certain parcels of land don't necessarily come up for sale that often. So when you have that opportunity, if you want to grow your business or you have want to make it be there for your family, you really want to go after it. However, there are a lot of pathways to grow your farm businesses. You know, there are some farms that are in phases where they're going to be aggressively looking to buy farmland. Other farms might follow a strategy where they want to rent farmland. I think what I've heard probably is what I hear about most in the case of successful farms that have been around for a few decades is that over time, they've gradually and slowly accumulated farmland looking for sales when they come up when it made sense for their operation. Now, there are several factors that influence whether any particular parcel of land that's up for sale would positively impact the long-term viability of your farm operation. And proximity to your current operation is one key factor to consider amongst several others. Even for me, going through this exercise and thinking about what the benefits are has been instructive and how important it is. And I've talked to several people in the state, and reported premiums for proximity, broadly speaking, are reported to be in the 20 to 40% range. So this is definitely something that producers are recognizing and paying for. And I think proximity really comes into play when you hear about record farmland sales, when you hear about farmland sales where you think that's crazy, why would anybody pay that? Well, a lot of times these sales involve competing neighbors. When you have that, the premium for proximity really does get fully capitalized into the farmland sales price. Now, I was able to find one example in print for Iowa. That's what's here on the screen right now. This happened in 2012, where you had a piece of land that sold for nearly $22,000 per acre. And yeah, that seemed a little bit crazy at the time, but when you looked into the actual situation, and I have it highlighted here, the buyers were neighboring farmers. Now, I looked very hard for an example from New York State and wasn't able to find. I asked several people about it, but I did hear that you have this happening in southern Cayuga County and heard a lot of stories about southern Cayuga County, so perhaps it would be nice if somebody wrote an article on this and I could use it for my example. This is the best one I could find now. So here's a brief outline of the approach I'm going to take. I'm first going to step back a little bit and talk about some farmland fundamentals, because I think it's sort of really important to have this framework when you think about what you're going to pay for farmland. And then I'll have a discussion of the benefits of proximity, and I'll give an example of how you can value proximity. I'm going to be doing this in relation to the cost of manure hauling, and then I'll end with some cautions. This is such a huge business decision. So first of all, when you talk about farmland fundamentals, first of all, it's important not to think of farmland like a commodity, or a commodity is a product where you can't distinguish one unit or one acre from the next. Farmland is very diverse. This is especially true in a state here in New York State. So it's hard to compare one parcel to the other. There are a lot of factors that go into the farmland prices that you see. And farmland markets in themselves, they are by no means typical markets. I mean, sometimes it hardly meets the definition of a market. Economists have a concept of perfect markets, and this is where you have a large number of buyers and sellers, and neither the buyers or the sellers can influence the market price, or individuals don't have any influence in the market. And this is very far from what we see in farmland, with farmland. Farmland markets are the classic case of a thin market, or farmland is rarely sold. On the next slide, I'm going to show the numbers for this. For New York State. One way to think about this is, say you've had 3 parcels of land that were sold in your county in the last year. And so how much information do you really get from those 3 sales? Like I said, farmland is very, very diverse, so each of these parcels has their own story, basically. And if you only have a few observations, it might be hard to say, well, what's the price for cropland in my county? On the other hand, let's say you have 20 to 30 sales that you can look at. So if you average out those sales, you have some average value, and all these sort of idiosyncratic factors kind of drop out, and you can have some idea of what the price should be, at least on average. But that can be very difficult to do locally. Furthermore, for New York State, at least for the data that I have, in the past 2 decades, more than half of all sales are non-arm's length. So more than half of all the parcels that are going up for sale in the state, or that are sold in the state, are between parties that are related. And then even when you look at arm's length sales, so sales between people who aren't related, even in this context, community and social connections can play a very important role. So if, a lot of land that is sold between relatives might not go up for a public auction. So it's important, if you're part of a local community or local networks, the time you spend having breakfast in a local coffee shop might pay off in this case, or a bar, I suppose. There's one study that put some numbers to this, and they found a 6 to 7% discount for friends, but an 18% increase in the minimum sell price for unfriendly neighbors. So farmland markets have a lot of these type of characteristics that are make them challenging to work in. So on this slide, I have both all acres sold in New York State over not quite 20 years, and I also have the total number of parcels that are sold. So in recent years, you've had about 70,000 parcels sold. There's about 7.2 million acres of landed farms in New York State. So you have less than 1% of farmland that's being sold between non-relatives in any given year. So there's not a lot of opportunity. Some land, if it's held by a family farm, it might not go up for a generation or a couple generations. And that's 800 total parcels being sold in the state in a year. These are all type of agricultural trends, all type of agricultural sales across all the counties in New York. So there's not that many opportunities to buy farmland. However, it is very, very important to farm businesses. And I'm talking about farm businesses here, so these statistics are for farms that are, generally speaking, operated commercially. For these farms, real estate makes up 70% of assets. It's 60% for dairy farms. So the vast majority of farm wealth is held in land and buildings. These investments tend to tie up capital for a lot of years. Payback period some of the prices that are paid by farmland, if you back it out, you get a payback period of 30 or 40, 50 years. And also in terms of tying up capital, this can decrease your flexibility to make other investments over the next decade or two. However, farmland, especially for dairy, it's necessary in a lot of cases for herd expansion. You want to increase your competitiveness, capture economies of scale, planning for farm succession. So this is a really important decision that has a lot of impact on the success of farm businesses. And so now I'd like to get more into the details of potential benefits of proximity for farmers. And I've kind of lumped these 2 groups into measurable and less measurable. Economists can pretty much put a number on anything, but some things are harder than others. There's very few things that are very easy, but some things are very challenging to put a number on. So first of all, transportation-related costs, and that's what I'm going to get into more detail on in a few slides on. So these would be labor and management costs, and you can think of this as both an operation and downtime. So, if you're hauling manure or silage, you might have somebody operating machinery, but if it's far away and that makes more difficult with coordination, you might have more downtime, and that's a real cost for the operation. Also, repair costs for machinery, depreciation, equipment ownership costs, how far away your cropland is might affect the equipment you own. And these are associated both with hauling manure and production of your own feed or forage. There's also, the bullet point here is reorganization or restructuring of your organization. So sometimes there's a case where if you have access to farmland that's closer or just access to more farmland in general, this means you're going to run your operation fundamentally differently. And so that's a more difficult calculation, but it certainly can come into play. And there are also things that are, I'd say, less measurable, but can be very important. Community or neighbor relations, that's something I hear a lot around the state. So that's some issue for some farms. And in some cases, that might be something you'd be willing to pay to be able to deal with. If you buy new parcel of land, in some cases, you might have access to a different road or access to water or something that really fundamentally changes the game for your operation. Another thing is if it gives you the option for future expansion. So you might not be at a place to expand right now, but if you have a certain parcel of land that comes up that you think will enable you to do that in the future, how do you think about what may or may not happen in the future? It's difficult to calculate, but it's an important consideration. So when you look at the estimation of these potential benefits, I'm going to focus on the incremental cost. So what's the change, or sort of giving these as variable costs, I guess, as well. And these are more straightforward and transparent to calculate than changes that affect your farm structure, sort of the restructuring that I talked about before. So what I'm not going to get into any detail about is what if this land helps you to move to a multi-site model for your operation? What if you can switch to using different types of vehicles or equipment? What if this allows you to increase your herd size? What I am going to do is look at the calculation. I'm going to do the net present value of the decreasing the distance that you have to have haul manure, and this is from an incremental perspective. So what happens when you have to just travel a few less miles for hauling manure? I'm using the net present value method. I'm doing this because it's fairly simple and transparent, and it gives a nice estimate of what are sort of the benefits over time of this having these sort of transportation-related savings. There's going to be additional transportation-related costs for feed and forage production. I'm not going to get into the details, and the same thing for farm structure, because again, those are just so operation specific that it's hard to be general. So for the data source, I'm going to use a study that Jason and Betsy did in 2012, and this study detailed the manure costs for 27 New York dairy farms. So the first disclaimer is this is not representative of all New York dairy farms. Most farms normally do not detail these costs. So this data is really quite unique, and I would argue, while it may not be representative, I believe it is quite reasonable. And these cows had an 840 milking cow average, ranging from 250 to about 1,200. And the range of costs here did vary quite a bit. You have $138 to about $442 per cow for manure hauling equipment. The average cost per cow was about $38, but the range was $5 to $74. And I am going to be using averages in the study. So if you think about your operation, these estimates that I'm going to make are more applicable if you fall in the middle of these ranges, as opposed to one of these extremes. All the farms in the study would have been following a nutrient management plan, and what this implies is that none of them were over-applying manure. So in that sense, our estimates would be on the conservative side. The costs in the study were for about a quarter of all the manure hauling requirement over the year. All of the farms used a haul and spread or haul transfer and spread. A couple of them did use custom hauling, and it was cost effective for them. And just another point to reiterate that the cost for any individual operation would vary widely, but hopefully the way I'm doing it is making it something that a broad range of farms can relate to. So now I'll go through the sort of key assumptions and calculations that I make to sort of quantify these transportation benefits. The first one is that costs for 2012 would be representative over the long term, and I didn't assume any change in the cost structure. We have seen fuel costs decline quite a bit recently. However, I would caution that the costs we're seeing for fuel may not reflect the long-term equilibrium. The next is labor costs. You know, there's a big discussion on the minimum wage going up to $15 in New York State, but more broadly speaking, we've seen labor costs increasing above the rate of inflation for a couple decades now. There's no reason to think that's going to stop. So if anything, expenses will get more expensive over time from what I'm using. The study covered about 25% of all manure hauling costs over the course of the year. What I'm assuming for my calculations is costs that during the other times of the year are similar. So if these costs weren't representative for all of the year, then these estimates would have to be adjusted. And what I do is I use the per mile cost, and I estimate the benefit of moving from a field that is 1 mile away versus 3.5 miles away. 3.5 miles, again, that was the average distance of a field from the operation for this study. And the cost that calculated per mile were 81 cents per mile, and this would include fuel and labor. And then the cost per load, in the next bullet point I have you have a little over 1 load per acre, the specific number of gallons per acre, and per loader there. So if you back that out, if you decrease your distance by 2.5 miles one way, that's 5 miles that you're not having to travel. The cost savings would be over $4 an acre for the study period and over $17 per acre per year. Depreciation and repair costs, that was a little bit tricky. So I made a somewhat arbitrary assumption. Now, I think a lot of the depreciation repair comes from either when you're spreading, just by the fact that you're using the machinery versus going a couple more miles. So what I assumed is that these costs are going to decline by 25%. The distance that I assumed that was being saved was a fairly large share of the total distance traveled. So if you make that assumption, you're saving over $19 a year in depreciation costs. So the total cost savings would come to about $36 per acre. And this is the savings from moving from a field that's about 3.5 miles away to about 1 mile away. So how do you think about these cost savings when you're bidding for land? And what I look at is the implied premium over different investment horizons. And this is where the sort of goals and structure, how your individual operation that really needs to come into account. And what I'm going to compare in this presentation is a 20-year investment horizon versus a long-term investment horizon. And so when you think about a 20-year investment horizon, this is more from the perspective of an investor that's looking on some, return on investment for over a relatively short time. And I'm saying relatively short time when you're talking about farmland. So then you really, if you're looking at it from that perspective, you probably, the 20-year time horizon is more relevant. And then there's what I'm calling the long-term horizon. And this is more 40 to 50 years. And from a sort of mathematical or computational perspective, once you have this long-term horizon, your net present value, basically it's mathematically equivalent to an infinite investment horizon. But that's sort of just if you're an operation, you've had identified successors, you want to make sure that your operation can thrive over several decades. You're willing to have a long payback period for farmland, and this is more relevant to you. I assumed a 5% discount rate in my calculations. This is going to vary based on your individual cost of capital and willingness to bear risk, so this can be adjusted. And so if you have a $36 decline in cost per acre, that's going to apply about $450 of benefits over a 20-year investment horizon. It does increase if you have that long-term investment horizon, so $729. So whatever the reality for your operation are, that's going to have a big impact on how you think about the premiums you pay for proximity or anything, or for farmland more generally. So the calculations I made, these are pretty simple calculations you can do in Excel. Obviously, if you're going to, if you're thinking about financing farmland, there's a sort of more complicated calculations you have to do to look at, you want to look at your share of equity and how you're going to finance this and have a conversation with your banker. But there is a nice rule of thumb that you can use, and this applies more to farms with the long-term investment horizon. But if you can look at what are the benefits per acre of proximity, what are your implied transportation costs? If you multiply this by a factor of 20, that's a pretty nice estimate for the implied premium. Or if you have a higher cost of capital, or if you're less willing to accept risk, if you're more risk averse, a factor of 10 or 15 might be more appropriate. The exact formula would be the cost savings, so in case $36 divided by your discount rate. So that's a nice shortcut you can use if you have a long-term investment horizon. Otherwise, you can go into Excel to calculate your net present value. Again, a more formal analysis is necessary to calculate what premium your operation can support, but hopefully this is helpful in seeing that, first of all, that these benefits can be substantial and that they should definitely be a part of what goes into the bids you'd be willing to make for farmland. Another thing I mentioned previously was potential benefits for neighbor relations, and these are really these can be difficult to quantify, but it's not impossible. And one thing to think about is how much time do you or your employees spend dealing with neighbors? I mean, do you have somebody that is coming over several times a year complaining about the smell? And does this stress you out? Does this take a lot of time? Does this distract you from other things you'd like to be doing from your operation? That might be quantifiable. You could think about it in terms of time. You can also think about what are the additional costs that might be occurred. And this might not be applicable to all operations, but what if you're using more expensive equipment? What if you have to travel longer and a longer route to get to a field to avoid that neighbor that just won't leave you alone? And so those are something, if you can think about, okay, so maybe that has some cost if you can think at time or specific expenses. Another way to look at it is how much would you be willing to pay to, say your case is you have 3 neighbors. If you buy this field, you'll have 3 neighbors that won't be affected by hauling manure, or it could be a number of neighbors. So think about what you'd be willing to pay on an annual basis to get on better with your neighbors. So in the example I have here in this slide, say you're thinking about purchasing a 40-acre field, and you think, okay, given all the time or money we have to spend, or just the headache, that you say it's definitely I'd be more than happy to pay $500 a year. In this case, just for the neighbor relations benefit. So if you break this down per acre. That's $12.50 per acre annually. If you use the approach that I talked about in the last slide, that's a $250 per acre premium if you have a long-term investment horizon. It's $156 premium if you have a 20-year investment horizon. So, these, depending on what your case is, something like neighbor relations could have an impact on what you're willing to bid for farmland, and it could be something that's worth backing out. Now, again, farmland is a major and very important investment, so I'd like to present some various cautions or just general considerations. The first one is the impact on local markets. And this is, again, I talked about thin markets before. Not a lot of farmland is being sold. If you buy this piece of land, will it have an impact on the market? And this is going to a degree, this is going to depend on the number of competing farms and what their strategies are. So it's helpful to know what other farms in your area you're doing. If you have a large number of farms and you're competing with each other, individual farms have less of an impact on the market. But if you only have a few farms that are competing, individual farms can have a larger impact. If you buy this piece of land in future years, it might be easier. You might not have the ability to compete for future sales, but it might make things easier for one of your competitors. So especially if you're in an area where there's not a lot of farms that are competing, this is something that's important to think about. Also, just more generally, if this is something that you're going to finance and it's going to tie up some capital for a period of time, it's also worthwhile to thinking, how does this current parcel compare to other parcels that may come up for sale in the next few years? Here's some general considerations. Some of these apply to capital investments in general, not just farmland. And the first one is, what is the frame of reference? Even for experienced business owners, it's easy to get caught up in current events. There's been all kinds of research that has shown that business owners, people in stock markets, this happens everywhere, where people tend to focus on more recent or easily available information. So is your reference $20 milk? Is it $2 gas? Is it a $15 minimum wage? And what are the implications of this? It's not something that you can necessarily, this is something more intangible, but it's worth thinking about when you're considering how much you'd be willing to pay to purchase farmland. What is driving this? What is your frame of reference? Are you in a high income year? You're in a low income year? How does this affect sort of your long-term calculation? Also, just to step back and say, is land purchase the best strategy for your farm business? Does it fit with your long-term vision? Are rental options available? Another thing I think that's easy to get caught up with in farmland, again, and just because of the nature of farmland markets, it's easy to think this is, we're never going to have this opportunity again, and that may very well be true, but it's worthwhile to, really reflect on this. Is this really a once-in-a-lifetime opportunity? Another important thing is, are there cheaper ways to lower your manure handling costs? So having land that's closer might be an option, but there also may be other efficiencies that you may be able to realize that might give you more flexibility than purchasing more farmland. Another consideration, can your operation handle the additional risk of taking on new debt? Another point I didn't put on there, but I think is relevant too, is your lender willing to finance the proximity premium? So generally they're gonna finance based on market value, but your ability to pay might be significantly higher because of proximity. So that's something that needs to be worked out. Also, when you make these calculations, I've talked about how this can change your equipment mix or other things, but if you're making this purchase, are there going to be other capital investments in terms of equipment or buildings that are necessary, and how is this going to change your approach? So just some general cautions that are useful to think about here. So to conclude, owning farmland that's near your operation can have considerable tangible benefits. It's easy if you add up the cost that I provided and assume that feed transport savings are comparable but a little less than manure hauling, it's very easy to illustrate $750 to $1,250 dollars per acre in an implied premium for farmland. I haven't considered everything here, but I think this does sort of give some idea of how important this calculation is, and I think this is also in line with the premiums that have been observed throughout the state. So it was sort of nice to see that, yeah, farms are paying more for this, but it's really backed up by these extra expenses that are being incurred. Also, to drive home this point again, the operational decisions associated with this might be very complex. Are you looking at using different types of trucks or equipment? Does this allow you to move to operating different sites? And I also think one thing is tricky but important. So what's the benefit of increasing your herd, and the benefit for increasing your profitability versus the cost of having to potentially haul manure to more distant fields? So these are very operation-specific questions, but they do definitely come into play in these decisions. And just to conclude, I think considering the full range of benefits of proximity can help with complex land purchase decisions. I look forward to your questions, and I had help to from several people in preparing this presentation that I've acknowledged on this page, and given you also a link to the study I used to get the cost estimate. And so it looks like we have plenty of time. I'll be happy to take questions offline. My contact information is here. It's JIFFT at cornell.edu. If anybody's more comfortable asking questions or just having a discussion that way, I'd love to hear your thoughts.
Thank you, Jennifer, for an excellent presentation. This is Kathy Barrett again, and on behalf of the PRODAIRY program and Dairy Business Communications, we'd like to thank you for taking the time to view this webinar.